America just crossed a financial event horizon that most people haven't even noticed yet, and the ground beneath our economy is about to crumble. The federal debt load has officially smashed through the $38 trillion barrier. $38 trillion. That figure exceeds the total economic output of our entire nation for a full year, and is accelerating by $2.4 trillion every 12 months. The proposed solution from the incoming administration? Tariffs. We are looking at heavy import taxes on China, Mexico, Canada, and Europe. The promise is a $2,000 payout for every household. The claim is that these trade duties will pay off the national debt. But the mathematics are completely delusional. Even if we place massive levies on every single import, we might generate $500 billion annually. The deficit by itself is $2.4 trillion. These trade revenues cannot even cover the yearly shortfall, let alone touch the $38 trillion mountain of existing liabilities. Yet the financial district remains blissfully indifferent. The S&P 500 has climbed to 6,640, hitting fresh records. Major banking institutions have hiked their forecasts. Barclays is projecting 7,400 by the close of 2026. Morgan Stanley is discussing levels approaching 7,800. UBS remains optimistic. They are all gambling on deregulation, tax reductions, and a boom in corporate earnings. Bitcoin is hovering at $97,000, knocking on the door of six figures. Investors are in a state of euphoria. Gold has rocketed to $4,050 an ounce. Why? Because a minority sees the storm gathering, while the majority remains blind. Most believe the administration will magically repair the damage with trade barriers and pro-business executive orders. They are mistaken. I am going to demonstrate precisely why the years 2026 through 2027 are destined to host a financial collapse rivaling the Great Depression of 1929. I will explain why the S&P is set to plummet from 6,600 to depths below 3,400. I will show you why Bitcoin is primed to crash from $100,000 to under $20,000. I will detail why the dollar is about to forfeit its global reserve standing. And I will clarify why the United States is staring down a debt emergency that makes every previous recession look like a dress rehearsal. This isn't about political affiliation. This is about arithmetic, and numbers never lie. We must begin with the debt, because that is the fracture point for the entire system. $38 trillion. Our GDP sits at roughly $28 trillion. This places our debt to GDP ratio at 136%. That stands as the highest level in our history, rivaled only by the immediate aftermath of World War II. However, there is a critical distinction. Following that war, America possessed manufacturing supremacy, a youthful and expanding workforce, and interest rates that were effectively zero. We grew our way out of that hole over 3 decades. Today, our manufacturing base is hollowed out. The demographic is aging rapidly. The baby boomer generation is retiring in waves, and interest rates are far from zero. They are sitting at 5%. In the 2024 fiscal year alone, the Treasury spent over $1 trillion merely on debt service interest. $1 trillion. That exceeds our entire military budget and surpasses Medicare spending. It is now the second largest expense in the federal ledger, trailing only Social Security, and it is compounding. Here is the trap. The government borrows $2.4 trillion more than it collects in tax receipts annually. That is the definition of our deficit. Consequently, the total debt swells from $38 trillion to $40.4 trillion by fiscal 2026. It hits $42.8 trillion in 2027 by 2030. We are looking at $50 trillion. Interest payments will consume $1.5 trillion every year. That means 20% of all tax revenue will go strictly to servicing interest. Not to defense, not to infrastructure, not to education, just simply paying bondholders. This is a terminal spiral, and there are only 3 exits. First, expand the economy faster than the liabilities accumulate. But isolationist tariffs will contract the GDP, not expand it. Second, inflate the debt away. Print currency and let inflation run hot. This obliterates the dollar's purchasing power and impoverishes the citizenry. Third, default. Simply refuse to honor the bonds. This would shatter the global banking system because U.S. treasuries are the bedrock of all finance. None of these paths are pleasant. All of them conclude in disaster. The president claims import taxes will eliminate the debt. Let me explain why this is economically illiterate and financially self-destructive. America imports roughly $3.4 trillion worth of goods annually. The proposal includes 60% levies on China, which sends us $500 billion in goods. There are threats of 25% duties on Mexico and Canada unless border issues are resolved. That impacts $800 billion in trade. And there is talk of a 10% to 20% universal tariff on everything else. Let's assume every single one of these policies is enacted. The 60% rate on Chinese goods brings in $300 billion. The 25% rate on our neighbors brings in $200 billion. The 10% baseline on the remaining $2.1 trillion yields $210 billion. The total is $710 billion per year. That sounds substantial until you recall the annual deficit is $2.4 trillion. These taxes cover less than 30% of the yearly shortfall. They do not pay down a single cent of the principal. They barely decelerate the bleeding. But the reality is even darker. Tariffs are not free cash. They are consumption taxes. American businesses pay them at the border and pass the expense to you, or they absorb the hit through lower earnings. When prices skyrocket, import volumes plummet. Consumers stop buying. Corporations shift supply chains. The actual revenue collected is always far below the theoretical maximum. Economic models project realistic revenue closer to $400 or $500 billion, not $700 billion. And that calculation ignores retaliation. When we tax China, they strike back against American exports. Farmers lose soybean markets. Factories lose machinery orders. Software giants lose contracts. Exports crash. GDP growth stalls. Tax receipts drop. The net improvement to the deficit could effectively be zero or even negative. Now consider the promised dividend. The pledge is $2,000 for every family. With 130 million households, that program costs $260 billion annually. So, if we take the optimistic $500 billion in revenue and subtract $260 billion in rebates, we are left with perhaps $240 billion for deficit reduction. That is 10% of the $2.4 trillion whole. It is a statistical error. Meanwhile, trade wars ignite inflation. Cost surge. Expansion halts. The Federal Reserve cannot lower rates because prices are rising. The economy tips into a recession. Revenue collapses. The deficit balloons to $3 trillion or higher. Tariffs do not fix the debt problem. They exacerbate it. This is why every economist, regardless of political leaning, calls this plan madness. But the administration disregards economists. The belief is that they know better, and the market is buying that narrative. For now, before we analyze the timeline further, consider joining the channel membership. Inside the members area, I deconstruct every chart, every warning sign, and every indicator that exposes how a collapse truly develops. No sensationalism, no static, just the actual mechanics behind the approaching storm. I demonstrate it incrementally so you can grasp the sequence long before the news cycle catches on. Let's discuss what Wall Street is projecting. Because at this moment, they are fully invested in the Trump trade. The S&P 500 sits at 6,640, marking all-time records. Third, animal spirits. CEO confidence is surging. Capital expenditure plans are growing. Stock buybacks are speeding up. The market thrives on hope. And currently, hope is at a fever pitch. However, every one of these bullish forecasts contains disclaimers hidden in the fine print. Barclays admits their 7,400 goal requires zero recessions, flawless policy execution, and stable credit markets. Their bearish scenario, should tariffs trigger a slump, is 4,500. That represents a 32% crash from today's price. Morgan Stanley warns of midterm instability and execution risks. UBS notes that valuations are extreme. Forward price-to-earnings ratios are in the low 20s, far above historic norms. Any bad news will hit hard. These are not guarantees. They are conditional wagers that nothing will break when history tells us something always breaks. Independent analysts are shouting alarms. They see the train wreck ahead. These policies generate stagflation. Tariffs bring inflation. Trade wars bring recession. The Fed is paralyzed because cutting rates spikes inflation, while hiking rates worsens the recession. Stocks and bonds drop in unison. There is nowhere to hide but hard assets and cash. Some strategists peg the likelihood. The market is priced for perfection. S&P 6,600 assumes flawless execution. Tax cuts must pass. Tariffs must be mild. Growth must endure. Inflation must sleep. The Fed must ease. Earnings must jump 15%. None of this is certain. Most of it is improbable. If a single pillar cracks, the entire structure fails. Let me walk you through the anatomy of the crash, month by month. This is not guessing. This is recognizing the pattern of every bubble in history. January through March 2026, the inauguration occurs. Aggressive tariffs on China, Mexico, and Canada are declared. Markets rally initially because traders fixate on tax cuts. The S&P climbs to 7,200. Bitcoin blasts past $100,000 to $120,000. Pure euphoria. Financial TV heralds a new golden age. Retail buyers flood in. Fear of missing out is rampant. But the smart money is silently exiting. Insiders are selling. Volatility is low. The VIX is asleep. Everyone feels secure. No one notices the iceberg. April through June 2026, the hangover begins. China retaliates against U.S. agriculture and tech. Soybeans, aircraft, and electronics take a hit. The Treasury Secretary signals that foreign demand for U.S. debt is waning. China trims its Treasury holdings from $770 billion to $650 billion. Yields spike. As rates rise, bond values plummet. Pension funds and insurers sitting on paper losses feel the squeeze. Mortgage rates leap back to 7%. Corporate debt becomes expensive. Q1 earnings reveal margin pressure. Revenue stagnates. Tariff costs bite. Profits miss targets. The S&P corrects to 6,214% dip. Not a crash, just a healthy pullback. Bitcoin drops to $90,000. Tech stocks suffer most. Pundits call it a buying opportunity. Dip buyers rush in, unaware they are catching a falling knife. July through September 2026, the credit event strikes. A major corporation or regional lender reveals massive losses. Perhaps commercial real estate loans default. Maybe a currency trade blows up. Maybe leveraged loans implode. The trigger is irrelevant. The reaction is what matters. Contagion spreads. Hedge funds on margin face calls. They must sell liquid assets. They dump everything. Algorithmic systems sense the weakness and magnify it. High-frequency traders front-run the liquidation. The S&P plunges from 6,200 to 5,200 in 3 weeks. October through December 2026, the damage spreads to the real economy. Q3 earnings are catastrophic. Revenue is down, costs are up, margins are crushed. Guidance for 2027 is slashed. Layoffs begin in earnest. Unemployment ticks from 4% to 6%. Consumer confidence evaporates. Wallets close. Retail spending drops. The economy officially enters a recession. 2 quarters of negative growth. January through March 2027, the sovereign debt crisis. A Treasury auction fails to find buyers at affordable rates. The gap is small, but the message is loud. Marginal buyers are gone. Foreign central banks are dumping paper. China goes under $500 billion. Japan sells another $100 billion. Saudi Arabia pivots to gold and euros. The Fed panics. They launch unlimited bond-buying quantitative easing on steroids. This saves the bond market but murders the currency. The dollar index crashes from 105 to 95. Import prices soar. Inflation hits 6%. Real wages plummet. The populace gets poorer. The S&P drops to 3,800. Bitcoin falls to $23,000. State budgets buckle. The political mood is poisonous. Presidential approval sinks to the 30s. Gridlock in Washington ensures nothing gets fixed. April through June 2027. The bottom. The S&P troughs at 3,400, down 49% from the high. Bitcoin bottoms at $19,000, an 84% drawdown. Unemployment reaches 9%. GDP has shrunk by 4%. This is the deepest recession since 2008, perhaps worse. Bankruptcies skyrocket. Commercial real estate is decimated. Regional banks fail, overwhelming the FDIC. Credit freezes. Only pristine borrowers can get loans. Consumers max out credit cards to buy food. Delinquencies spike. Repossessions surge. Foreclosures climb. This is a depression for the working class. The wealthy survive and buy assets for pennies. The middle class is hollowed out. Retirement savings are halved. Home equity evaporates. This is the destruction of generational wealth. July through December 2027. Stabilization. At 3,400, stocks are finally cheap. Valuation metrics align with history. Value investors step in. The Fed finally slashes rates to 3% as demand destruction kills inflation. This offers relief. The dollar stabilizes, though significantly weaker. The S&P grinds to 4,200 by year-end. Now, we must focus on Bitcoin because its role is misunderstood. At $85,000, the crypto community sees $500,000. They argue the president is pro-crypto. They expect a strategic reserve and friendly laws. In the short term, they are correct. Bitcoin likely hits $120,000 in early 2026, but then it crashes. Why? Because it is not yet digital gold. It is a risk asset correlated to tech stocks. In 2022, stocks fell 25% and crypto fell 65%. It is a leverage bet on liquidity. When the crash arrives, Bitcoin gets decimated to $19,000. Leverage is the enemy. Futures and options amplify the drop. Margin calls forced selling, which triggers more selling. Retail investors who bought the top lose everything. However, in late 2027, as the dollar crisis becomes undeniable and the money printer runs hot, Bitcoin becomes attractive again. It climbs from the ashes to $30,000. By 2030, it could reclaim highs. But the journey goes through the valley of death. If you hold it now, consider reducing exposure. You can buy back lower. Riding it down 80% is financial negligence. Gold is the victor here. It falls briefly during the liquidity crunch, but surges as the dollar dies. By late 2027, it hits $4,500. It has no counterparty risk. Central banks are buying record amounts to prepare for the dollar's twilight. You should follow their lead. Let's talk about the human impact. This isn't abstract. A $1 million portfolio becomes $550,000. Retirement is pushed back a decade. Homes lose 20 to 30% of their value. If you have low equity, you are trapped. 9% unemployment means 15 million people without paychecks. Graduates find no work. Older workers are pushed out permanently. Families burn savings. Cars are seized. Small businesses vanish. The wealth gap explodes. Social unrest intensifies. This is the true cost. Is there an optimistic path? Maybe. Perhaps the administration threads the needle. Tariffs are surgical, not blunt. Spending is cut. Growth persists. I give that a 35% chance. In that world, stocks hit 7,500. But if I am right, the S&P hits 3,400. Bitcoin hits $19,000. The dollar loses 20%. The U.S. loses its AA status. This scenario has a 30% probability. The risk-reward is terrible. If things go right, you gain 13%. If they go wrong, you lose 49%. Smart money reduces equity exposure to 40%, holds cash, and buys gold. Don't be greedy. Don't try to time the peak.